What are we meant to be reading from this market? Komal Sri-Kumar, perfect person to be talking about it, president and founder of Sri-Kumar Global Strategies, a global consulting firm, advises, of course, sovereign wealth funds around the world. Joining us from LA, Sri, your take, the commodities sector worried about growth, the treasury sector, not so much.
Well, I think on the commodity side, Caroline, what you have is the result of the Chinese developments in last few days suggesting that the economy may be slowing and China may not be off the COVID crisis after all. That in turn are causing a problem in terms of commodities, including gold. In that sense, industrial metals are down, farm products are down, all the commodities are down. I don't think that means that inflationary fears have gone, and inflationary fears are getting reflected in the 10-year bond yield that you spoke about. So you can have both of them coexisting. The point for the medium term, Caroline, is that even if you have growth slowing, if you're going to keep inflating the global economy as both the Fed and the ECB have been doing with month after month of bond purchases, you can have inflation without economic growth. And that's what I think the market is missing.
That is a concern here, Sri. I do wonder, though, whether that actually can be the case. Right now, the Fed is, or the U.S., I should say, by default, is going to be out front on this. And there's a general idea that the rest of the world and the rest of the central banks, for the most part, will follow what the Fed does, whether they want to or not. Is that not the case anymore? Has that correlation broken down to the point where maybe we should start to be concerned about some of the stagflation?
We should be concerned about stagflation, Romain, and even whether the rest of the central banks follow the United States or not, stagflation in the United States is becoming more and more of a reality. Bloomberg News today had a great report citing the Federal Reserve Bank study showing consumer inflationary expectations are at an 8-year high, both over the next year and the next 3 years. So what this is saying is that inflationary expectations are getting ingrained in the consumers. If that happens, and again, I'm old enough to remember both 1973 and 1979, Romain, that's how inflation became entrenched. And that's how the word stagflation was born. I don't think we are far from it.
So then what do you make of comments from Atlanta Federal Reserve President Raphael Bostic hinting that we need to taper, we need to do it sooner than we previously think? Is that the right course, Komal?
Yeah, Taylor, I think both the Atlanta Fed head as well as Mr. Kaplan from Dallas have been at the forefront in terms of talking about the need to taper faster, and I think they are spot on. The problem with the Federal Reserve is that essentially the chairman has told the market to ignore the dot plot. They don't even publish them anymore. And his word is what you hear in public, and which is inflation is transitory, and he's going to keep repeating it. And as long as the chairman leads the rest of the board, and you do not have a revolt within the Fed, as we had with Paul Volcker in 1987, if you have an obedient Fed, that his word is going to have the sway.
Well, Sri, though, and that's a great point, Sri, but I do want to go back to what you were saying about the stagflation and the potential for that now. But you draw parallels to what we saw back in, 73 and 79. In both of those instances where we're talking about just a massive uptick in commodities prices, primarily energy prices. Obviously, you had the big oil energy crisis here in the U.S. oil embargo, I should say. There's no real sense here we're going to get a repeat of that, at least in the oil market. And I'm wondering, how do you end up with 1970-style stagflation or anything close to it if we don't also see 1970-style energy prices?
Now, but that, Romain, is an excellent question, a timely one. What we had in the 1970s was one single commodity which was in short supply, namely oil. And that was an essential. There were very few substitutes for oil that we had in the 1970s. No electrical energy, no electric cars, no solar energy. You are correct. You have them all. But what you have today are the supply bottlenecks which are persisting, and they're not going to go away for a few more years. And under those circumstances, the single commodity shortage, which did not have a substitute, which was a story in the 1970s, is being replaced by several commodities in short supply, each one of them contributing its part to the stagflation. So it's a somewhat different story, but you raise a good point. You don't have one single commodity, but we have a number of other commodities together which still play a significant role.
Yeah.
And at the same time, in common with the 1970s, fiscal deficit has remained high. Monetary policy is very expansionary. President Gerald Ford in 1975 said, whip inflation now, and he gave buttons to everybody.
Yeah.
They put them on, it sold a lot of buttons, but it didn't do anything to inflation.